Stagflation. It's a word you're probably going to hear a lot more of in the coming months. And it's a scenario that genuinely keeps economists and policymakers up at night. It's this tangled economic knot that can be incredibly difficult to undo. So let's get right into it and unpack what it really is and why it's becoming such a huge concern right now.
So, let me ask you a question. What do you think is the absolute worst-case scenario for an economy? A deep recession, with people losing their jobs? Or maybe runaway inflation, where your money just doesn't buy what it used to? Well, here's the thing. What if you didn't have to choose? What if you got the worst parts of both happening all at once? That right there is the threat of stagflation.
Okay, so here's the textbook definition. Stagflation is this uniquely toxic cocktail, a perfect storm of three things you never want to see happening at the same time. First, you've got a stagnant economy, meaning slow or even no growth. Second, you have rising unemployment, so more and more people are out of work. And third, on top of all that, you have persistently high inflation, where the cost of living just keeps climbing. Any one of these is bad enough on its own. All three together, that's a full-blown economic nightmare.
And this is what makes stagflation such a difficult, tangled knot to undo. It's a real paradox. See, the usual economic playbook, it just doesn't work here. Think about it. To get the economy moving and create jobs, what do you normally do? You cut interest rates to make money cheaper, right? But in this situation, that just pours fuel on the fire of inflation. Okay, so what if you try to fight inflation? Well, you raise interest rates, you hit the brakes. But doing that almost guarantees you'll slow the economy down even more, and people will lose their jobs. You're basically stuck. Every cure for one part of the problem makes the other parts worse.
So hearing all this, you might look at the official numbers and think, well, hold on, things don't seem that bad. And you'd have a point. But this is where we need to dig a little deeper. Because the headline data we see on the news, well, it often hides some pretty serious cracks just below the surface.
Let's start with unemployment. You look at the official rate and, wow, it's historically low. On paper, that looks fantastic. It paints a picture of a really strong, healthy job market. But is that the real picture?
This is where that simple headline number starts to fall apart. See, it doesn't show you the growing number of people who've just stopped looking for work altogether. They've simply given up. It also hides the huge problem of underemployment. People working part-time gigs when they need a full-time job, or folks with degrees working jobs that don't even use their skills. And this is a big one. Not long ago, the official job numbers had to be revised downwards by the largest amount ever. They basically admitted they'd overestimated things by almost 1 million jobs. The very surveys this data comes from are also getting less and less reliable. So that clean, simple number, it's masking a much messier reality.
And you know what? We see a really similar story playing out with inflation. The main number you hear about, the Consumer Price Index, or CPI, shows that inflation has come down a lot from its peak. And again, that's a headline that makes it sound like we're winning the fight, that the worst is over.
But it's not capturing what you and I actually feel in our wallets. For one, there's shrinkflation. We've all seen this, right? You pay the same price, but the bag of chips is half empty. The official numbers also have a really hard time keeping up with the true cost of housing, which is, for most of us, our single biggest expense. And maybe the most important point is that even if inflation is down, that doesn't mean prices are going back to where they were. All those huge price hikes we've seen, they're now baked in. They're the new normal.
So, okay, the data we're looking at is shaky at best. But what makes this whole situation even more dangerous is that there's a fundamental conflict happening right at the top. The two main groups in charge of managing the economy, they're literally pulling in opposite directions.
In a perfect world, managing an economy should look something like this. You have the central bank handling monetary policy and the government handling fiscal policy. And they're supposed to work in sync, like two hands playing a delicate instrument, perfectly coordinated to keep everything in tune.
But what we have right now is the complete opposite. It's an economic tug-of-war. On one side of the rope, you have the Federal Reserve. Their job is to fight inflation, so they're raising interest rates, they're slamming on the brakes. But on the other side, you have the government, which is pumping tons of money into the economy through record spending and tax cuts. They're stomping on the gas pedal. It's like driving with one foot on the brake and one on the gas. It's not just inefficient, it makes the whole situation worse.
In this battle, this tug-of-war at the top, it doesn't hit everyone the same way, not even close. What it's actually doing is creating this deeply uneven reality, a split that economists have started calling a K-shaped recovery.
Just take a look at these numbers. It's pretty staggering when you see it laid out like this. The wealthiest 10% of households are now responsible for half of all consumer spending in the entire economy.
Let that sink in for a second. The other 90% of the country makes up the other half. It tells you that our economy has become incredibly dependent on a very, very small group of people.
And that's exactly where this idea of a K-shaped recovery comes from. Just picture the letter K. There's one arm that goes up. That represents the wealthy, whose assets are growing. But then there's the other arm, the one that goes down. That's pretty much everyone else, falling further and further behind. And the scary part is, the policies we have in place right now seem to be making that split even wider, even faster.
So let's break down exactly how this policy fight impacts these two different groups. When policymakers try to stimulate the economy with low interest rates, who really benefits? It's the asset owners. Their stocks, their real estate portfolios, they inflate in value. But for regular wage earners, it's a totally different reality. They're just trying to keep up with rising prices for groceries and gas, and their debt, things like credit card balances, that doesn't really get cheaper. It just gets harder and harder to get ahead.
Now, you might think this is just a US problem, but it's not. Because of the central role the American economy plays in the world, what happens here doesn't stay here. The struggles we're talking about are absolutely guaranteed to send shockwaves around the entire globe.
And the reason for that is actually pretty straightforward. The US dollar is, for all intents and purposes, the world's currency. Most major global trade, whether it's for oil or coffee or electronics, it's priced and paid for in dollars. That means the health of the entire global financial system is fundamentally tied to the stability of the US dollar.
So this creates a really dangerous ripple effect. The US can essentially export its inflation and its economic problems to other countries. And people are noticing. You have global institutions, even entire countries, looking at the massive US debt and these conflicting policies, and they're starting to get nervous. They're starting to look for alternatives to the dollar. And if that trickle turns into a flood, if there's a sudden loss of confidence in the dollar, that could absolutely trigger a massive global financial crisis.
Which brings us right back to where we started, that tangled economic knot. Getting out of this mess, it's not going to be easy, and it's definitely not going to be painless. It's going to demand some really tough choices and almost certainly some short-term pain for long-term stability. And so the big question that leaves us with is this: what are those sacrifices going to be? And more importantly, who is going to be asked to make them?